Hello, everyone. On behalf of the Counselors of Real Estate, welcome to this presentation of insurance, rising risk, rising premiums, rising alternatives. Thank you for joining us. My name is John Bacheski, CRE. I'm currently the second vice chair of the Counselors of Real Estate and the president of Real Estate Fiduciary Services, which is located in Somerville, South Carolina. The Counselors of Real Estate is a distinguished international group of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. I want to recognize our exclusive sponsors for today's webinar: Busac Real Estate, Capright, and Equus Capital Partners. We're all grateful for your support. Before we begin, I'd like to offer you a free subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. If you don't already subscribe, please visit cre.org/REI. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. It's my great privilege to introduce today's moderator, Robert Griswold, CRE, president of Griswold Real Estate Management in San Diego. A longtime counselor and certified property manager, Robert routinely serves as a court-appointed receiver and has an active litigation consulting and expert witness practice. With more than 4,000 litigation assignments completed. Invited to counselor membership in 1997, Robert is the author of 12 of the best-selling books in the For Dummies series. Welcome, Robert.
Thank you, John. It's a pleasure to be here, and welcome to everyone around the country, around the world. I think you'll find this is going to be a very interesting time. Of course, commercial real estate insurance costs have risen. Statistically, it's 7.5% annually, although most experience I have is people are seeing their premiums double or triple. Quite a few people are being canceled or non-renewed, and it's a crisis in many parts of our country. So we're going to talk today about what real estate owners, large and small, are doing to reduce the risk. What is the impact on development, on leasing, on sales? I personally know of a couple of property sales here in Southern California that are on hold. They can't find insurance. One property in particular, the only quote they could get for insurance is $600,000 a year after their policy was canceled or non-renewed at $50,000 a year. Only problem is that's about 87% of the gross potential income of the property. Pretty tough to make that pencil out when you're paying 87% of your gross collections to insurance. So we have a couple of experts here today to help us out. And first up will be John Kempton. John is Senior Vice President of FHS Risk Management. He started there in 2023 as a senior consultant, providing risk management and insurance consulting services for large real estate investment firms across the country. In this capacity, he is responsible for advising clients on program design and implementation, negotiating contracts, and implementing overall risk management strategy. He's been in the industry since 2012, and formerly was with Southeast Zone Real Estate Leader and Senior Vice President for Marsh in Washington, D.C., where he was selected as a real estate power broker in 2023. Previously worked for another global broker. After John, we'll have Aidan Jew. Aidan is the head of North America Alternative Risk Transfer Group. That's one of the acronyms you'll hear today, ART, Alternative Risk Transfer. He's with Marsh USA, and he focuses on ART and based in New York City, responsible for coordinating delivery of all Marsh's ART resources to clients, supervising client teams, developing marketplace strategies, and crafting solutions for unusual business and insurance risks. Aiden's expertise with clients' complex risk financing and management needs includes the design of both traditional and alternative risk programs such as bespoke risk transfer, performance warranty insurance, structured risk programs, integrated programs, parametric solution, and non-damage business interruption. Well, I'll look forward to Aiden explaining what some of those terms are. But we're going to start out with kind of an overview from John. John, welcome.
Thank you. It's very nice to be here. Thank you, everyone, for the time today. And it's a good time to be talking about insurance. I think, as Robert mentioned, after it seems like 7 or 8 very challenging years in the insurance market with double-digit and sometimes triple-digit premium increases year over year, we are starting to see, and I'll knock on wood real quickly, a stabilizing of the property insurance market. And I think, as many of you are aware, the property insurance premiums typically make up about 60 to 70% of the overall premium spend on a property level basis. So seeing some stabilization enter the market is a welcome respite after 6+ years of frankly, disproportionate premium increases. If we look back a year ago, I think we were in a very different market where the property market, after 5 years of hardening, seemed to hit the worst hardening of that hard market, with people seeing 20, 30, 40% rate increases. If you were in markets like California or Florida, triple digits weren't out of the question. And I think when that happened last year, a lot of real estate owners quickly asked, what can we do to stop the price increases? And I think as we look forward, the markets will be cyclical, but they're generally starting to trend up. And I think the most important thing for us to look at over the longer term is why are losses increasing, and how can we most efficiently manage risk? And when I say manage risk, it's what can we as real estate owners afford to self-insure? What can we afford to, how can we take some of those exposures and via contracts transfer to third parties? And then what do we want to transfer to insurance? As a consequence of a very long, soft market, most real estate owners took advantage and bought insurance with very broad coverage, high limits, low deductibles at very inexpensive premiums. Those days are over. Losses continue to increase every year. Even last year, when we didn't have a large hurricane that made landfall, we still had over $100 billion of insured losses. And we're seeing new risks start to emerge. Largely severe convective storm, which was, I think there were more than $10 billion severe convective storm events in the US last year. So as we look at that, if losses are going to continue to increase, insurance companies are a for-profit business and they need to remain profitable. So how can we begin to build programs that have lasting structures? And that's where Aiden and his team come in around alternative risk transfer. The old way of buying insurance it's a relic of the past. Things will get easier this year, but they will not return to the levels that we had back in 2015, 2016. So it's devising solutions to make your programs as efficient as possible over the longer term. I think the one other thing that I would note is as property has improved, we are seeing on the casualty side of the market, which again is a smaller portion of your overall premium spends, that market is starting to become more challenging. I'd say that it's more pronounced in certain segments of the business. If you're in the residential, hospitality, senior living spaces where you have people living or staying at your properties, you're going to be disproportionately affected by this. But again, this is an area where claims are growing, from both a numbers standpoint and a dollar standpoint, and that's a twofold issue. One is social inflation. An injury that cost $25,000 20 years ago is going to cost substantially more today. So just the general cost of covering claims has gone up. But exacerbating that is severe jury verdicts that we've seen over the past few years, where claims in which the owner has, I would say, negligible liability.
I apologize. Can you hear me? All right, perfect. My phone went out real quick. So juries are finding verdicts $10, $15 million in situations where you as a real estate owner would seemingly have little to no liability. And that is unfortunately a consequence of bad laws and runaway juries. So that's another thing that we need to think about over the longer term. And in an effort to moderate our insurance costs, we need to ensure that there is good tort reform across the country. And, certain jurisdictions like Fulton County, which has become the #1 judicial hellhole in the country, we rein in some of that runaway jury verdicts, because that's another area that is certainly driving the increased costs that you all are seeing in the market.
John, let me interject. I also see the building costs. So this whole inflation that has hit everything is not only inflating jury verdicts based on the medical care and treatment and future medical and future care needs, from a life planning standpoint, but just straight construction costs alone. We're seeing, 30, 40% increases in the requirement just for, fire, rebuilding and so forth. So you can pretty much do the Marshall and Swift and all these things are reflecting much higher numbers, which reflects higher limits that are required by lenders, which of course affects the premium because there's substantially more risk for the insurance company. Is that correct?
Absolutely, and it's a great point, because we had the experience of COVID where we saw material inflation, particularly in the construction industry at the onset of COVID, where construction costs rose rapidly. And you as a real estate owner have an obligation to provide an adequate replacement cost to your carriers for underwriting. And the way that your property premium is calculated is the carriers derive a rate which is based on the occupancy type of the building, the construction type of the building, its location, loss history, and they apply that to your reported values to generate the premium. And prior to 2020, 2021, insurance carriers were not doing adequate diligence on the adequacy of replacement costs. And many larger real estate owners purchase their insurance on a blanket basis, where you'll buy a large per occurrence limit and the reported values are just there for premium development purposes. And I would say savvy owners understanding that rate times value equals premium, and the carriers were solely focused on rate and were not focused on values, capitalized on that inefficiency. And we saw many real estate owners, particularly on wood frame multifamily, where your rates are disproportionately higher than a non-combustible office. They'd build a building for $40 million, turn around and insure it under their program at $20 million to keep their costs low. So that plus the inflationary environment of the past few years really led to seemingly disproportionate increases in replacement costs. A lot of people just started at a basis that was well below reality, and so had to catch up and then address inflation. Nowadays, it's something that carriers are incredibly focused on, and without the ability to explain or defend your values, carriers will oftentimes add co-insurance penalties or restrictions to the coverage that would limit your ability to recover if you were to have a complete casualty event. That said, go ahead.
John, I was going to also say that we're seeing renewals that are conditional. So they'll say things literally like how old's the roof? They'll come out and inspect it, and they'll say you have to put a new roof on. Again, these are not things that necessarily budgeted, or they're budgeted maybe down the road a few years, but essentially they blackmail you and say, if you want your policy renewed at all, you need to do this or that. So we're also seeing the CAP index, which is a crime score that's often used. And so certain areas, it's sadly out of the hands of most property owners to control crime in their city, are also negatively affecting it. So I think we get the idea of all these different factors. Let's start talking about, is there anything on your end, John, before we go over to, Aiden, that you can say are solutions or suggestions? I mean, you alluded to one of trying to get an insurance company that will theoretically undervalue your replacement cost to their detriment. That's always a good strategy if you can do it, but not as easy. Are there any other strategies? Talk about, higher deductibles or even just in the conventional before we get into ART and alternative risk transfer with Aiden.
Absolutely. And I think one of the key things is, while the carriers are now very focused on valuations, it doesn't mean that they're always correct. They're relying on core logic information. So one of the things it's key going into any renewal is ensuring that you have a good narrative around developing your values. Industrial is a great area where the core logic estimates are probably about 30% higher than what people are building industrial for. And as a consequence of that, people who are going into their renewals, who own large industrial portfolios that can show, I've built these 10 properties over the past, 5 years. I can demonstrate that my replacement costs are $50 a foot. So while you as the insurance carrier think that it's $100 a foot, let me show you why your numbers are flawed. And I'm the professional. I have the information to back that up. So data quality is essential. And when you get into specific areas like Florida or California, where you either have earthquake risk or hurricane risk, there is a lot of information that you can gather about your properties that feed into the models that these carriers use to develop your premiums. And Robert, you mentioned one around roof age. So a lot of carriers, to your point, are increasingly putting roof restrictions on coverage restrictions on properties that have roofs over a certain age. But that's a key area where not only do you want to let your carrier know if you've replaced your roof, but you want to make sure that that data is getting onto your submission schedule of values that feeds into the model. Because if it's showing you've got a 40-year-old roof on this building, it's going to model disproportionately worse, and your premiums are going to be substantially higher than were you to have a information that showed that you had just replaced the roof and it was 5 years old. So data quality is key. And then assessing your deductibles. For a very long time, carriers were willing to write policies with very low deductibles. And what's happened over time is you get into a place where you wind up, as the carriers like to say, trading dollars. If you're spending $1 million in premium and you have a $50,000 loss, the carriers don't want to pay out the $25,000 over the deductible. They want to be there for the multi-million-dollar loss. I liken it to your auto insurance. If you had a claim under your auto insurance every year, you'd be uninsurable at a particular time because the carriers just don't want to deal with the administrative burden of adjusting claims. So it's determining what deductibles you can live with, negotiating with your lenders to allow for higher deductibles based on current market conditions, and then creating some, whether it's internally creating deductible buy-down systems where you're funding for expected losses within that new deductible. That way you're paying one for one on a dollars basis versus carriers need to make profit. So if they're expecting to pay out $500,000 in claims on your portfolio every year, they need to charge you $800,000 to $1 million for those expected losses, and then they factor in the risk transfer. If you can take that $500,000 expected losses and pre-fund that internally, now you're paying dollar for dollar for that risk, so there's greater efficiencies. We see that in the multifamily space with the creation of what's called an aggregate deductible. What this is again, if you have a portfolio of, any more than probably 2,500 to 5,000 units of multifamily, carriers expect that there's going to be some level of frequency every year. And as such, they'll look to push your deductibles to 250 or 500,000 per occurrence because they don't want to pay for the attritional losses. What you can do is implement an aggregate deductible where you'll say excess of our $100,000 per occurrence deductible, we, the insured, are responsible for the first 500,000, $1 million, $2 million of losses every year. Once that erodes, the carriers come and they sit excess of the deductibles. That moves the carriers away from those attritional events, puts them further away from having to adjust claims on a frequency basis, and can make your programs more efficient. And one of the benefits of that program is, for most people, insurance is a fixed cost. You don't have any, you pay your premiums, you don't have any claims, you don't get any money back. The creation of some of these structures does create some variability in the costs, where it empowers you as owners of real estate to the extent you can manage claims. There's some money left over that you can use to pre-fund that aggregate next year. You can distribute funds back to your assets. So there's a lot of structure that you can implement that will help control costs over the long term and take some of the fixed nature of insurance and move it into a more variable structure.
John, let me interject. You talk about, large portfolios, but some of the people on this seminar might have smaller portfolios. Is there still the opportunities of this blanket coverage or the aggregate deductible if you've got, let's say, 1,000 to 2,000 residential units, just to pick one industry example?
Absolutely. I think, this is something where the greater the size of the portfolio, the greater the premium spend, the more the flexibility. But most of these things start at a very high level and then trickle down. From an aggregate deductible perspective, as soon as you have any frequency of claims, and that's where you typically see this more on the multifamily side than you would if you were had an industrial portfolio where the claims volume just isn't there, you can start to implement these. But even in a one-off, if you're just insuring a property on a single asset basis, there are opportunities to review the deductibles, review coverages, ensure that you're buying what you need. One thing that happened in a very soft market is people bought too much insurance on both the property and the liability side. Historically, you could buy excess hurricane insurance for next to nothing. So everybody bought full limits for named windstorm coverage. And then lenders started requiring that. As if you use that and compare it to California earthquake, you typically bought to the 500-year return period. Well, now you're in a situation where in Florida, buying that excess limit is prohibitively expensive. And when you model these risks, it's showing that, the expected loss excess of a certain amount is 1 in a 10,000 year event, which nobody could reasonably insure to. So that's where it's making sure that you've got the quality data. You're using these analytics to determine what you need to purchase. You're working with your lenders to defend those limit purchases that you're buying, because most loan agreements older than a couple of years ago still require full limits. And then you're making sure that you're buying the right insurance for what you need versus some antiquated, limit that was chosen in a very different time frame.
So you bring up an issue, which I don't want to spend a lot of time on, but you should really look at the lender documents and their insurance requirements to see if there's something that you can get in writing so you don't have to necessarily do full limits. I wanted to touch on one last topic before we go to Aiden. You mentioned data and you mentioned CoreLogic. Can you just briefly talk about CoreLogic being a company that collects and aggregates this data? I guess it's almost kind of like the 3 credit bureaus. If you get a bad mark on your credit, is there any appeal, or can you have a direct input into what the CoreLogic is telling the insurers? Because if you have some incorrect information or wrong information, I could see, like you said, that 40-year-old roof. If that's on their data sheet, we don't see it as the owner or manager. And then you wonder why you get 20 denials. Maybe they have false information. Is there anything that can be done from an owner or manager perspective to make sure CoreLogic's information is accurate about your buildings?
Yeah, absolutely. So CoreLogic, they're simply a tool, and they're the default tool for, I'd say, insurance brokers, insurance carriers, all use some version of CoreLogic. And it's by virtue of it being a tool, it can give you as good or as bad of information as you want. The output's only as good as the input, and you can develop values with, I'd say, probably 5 or 6 pieces of information, and then you can develop far better values with 20 to 30 pieces of information. So that helps develop the replacement cost estimate of the property. And if it's something that if your broker is providing those replacement cost estimates, most brokers have access to CoreLogic. It's something that you should review with them. Again, as the real estate professionals, you probably have the best baseline of what the replacement cost should be. Understanding what replacement cost means is important. It's different. It's, if the building burned down today, what would be the cost to repair, replace, and like, kind, and quality? It removes land values. Oftentimes, you may want to remove certain horizontal improvements. So it's understanding that information, and then it's making sure you're working directly with your broker, because oftentimes you as real estate owners are making various improvements to your properties, and that information isn't getting to your broker, and it's not getting into your schedule of values. And that is the information that's provided to the carriers each year to develop your renewal. So it's important, I would say, to work with your brokers to make sure you're reviewing that data, you're informing them of these improvements, and you're making sure that that gets to market.
Okay, no, that's a great point. I know, for example, personally, if you have the Zinsco or Federal Pacific stab panels, and let's say you replace them, but that information doesn't flow into the CoreLogic. That's one where it could make a huge difference. No one's going to touch you if you've got the bad panels. We had a question that I think is worth interjecting at this point. So I lied. One more little comment from John, then we'll go on to Aiden. How flexible are lenders on deductibles right now? I've got a situation myself where a non-renewed in May. The last similar property went up from 105,000 per year to 498. That's a pretty healthy increase. Now we're looking at a similar size property, multifamily, not in California even, or Florida, where the premium is going to go up. We're looking at higher deductibles. Are lenders willing to do that because the loan is not due to be refinanced for a few more years? Will they consider that?
Absolutely. It's something that lenders, last year when you talk to lenders and their consultants, they outsource a lot of their insurance diligence to third parties, and they're a handful that do the majority of the work. Much of what they did was field waiver questions. This first came up in 2018, 2019. Historically, it was very easy to get a $25,000 per occurrence deductible. Every loan agreement had $25,000 maximum deductibles. And in 2019, the large commercial space came back and said minimum deductible is $100K. So in those cases, most lenders, I had a client, we probably had close to 150 properties. Let's say 50 of them were non-compliant. We were able to get waivers in every single one of those instances. So it's making sure that it's leveraging the resources of, if you have a risk manager in-house, if you have your brokers, to provide data to help explain the non-concurrency and the non-compliance issue. Deductibles are frequently an easier one to go through, as long as you're not increasing them too dramatically. One thing that we are seeing with lenders too is they may accept a higher deductible in exchange for some level of recourse to close that gap. Give you an example. We provide some lender consulting services to various credit funds. And one of those, the borrower has a $750,000 water damage deductible. So in that case, we were able to get some level of recourse from the borrower to kind of finance that gap between what we'd require. So those are ways that lenders are getting creative. On the limit side, and this is particularly true in Florida or any coastal area where your hurricane insurance is getting too expensive, if the loan agreement, if you're signing a new loan agreement, I'd never agree to, it's important to negotiate as flexible of terms as you can, right? If your current deductible is 100,000, push for $250,000 or $500,000 deductible. Not that you have it today, but you may need it in the future. And on the win side, it's going to the lenders with data. It's going with that modeling information to show you're acquiring full limits. The chances that I'm going to have a loss that's going to exceed $40 million is 1 in 5,000 years. That, what I'm proposing is to buy a limit that's equal to 1 in 1,000-year return period. And usually if you can provide that information, the lenders are far more amenable to working with you than if you just come and say, I can't find the insurance, I need a waiver. It's important to have that backup in those conversations.
Okay, John, great. Aiden, welcome, and we'll let you jump in here. Any comments you have on anything John and I have talked about so far, feel free. But you're going to talk about ART, alternative risk transfer, and some creative ideas that might help us.
Thanks, John. Thanks, Robert, and thanks, John. It's always good to kind of dovetail off of John and some of the traditional insurance information. I'm honored to be here at the CRE and to present. Real estate has been a major focus of Marsh alternative risk transfer team for the past 3 years and ongoing. We're still facing, still a challenging marketplace, right? Especially for real estate clients. And we're seeing that. I think it's been 26, 27 consecutive quarters of increases in the property market. And we're kind of seeing a stabilization, like John mentioned, right, in the insurance rates. But we still see clients and companies that are coming to us with issues and challenging layers of their program, right? And I'll get into the details, but we're also seeing an increase in the casualty side as well, right? The casualty side of the real estate industry is starting to see what we call a hard market. A hard market is when you're starting to see that, increase in the pricing and the premiums, right? So we're starting to see that. But what I'm going to present today is exactly what it sounds like: alternative risk transfer. It's an alternative way to look at insurance, and we've been highly successful at bringing different solutions, right? It's not an off-the-shelf question. It's not an off-the-shelf solution. It is highly customized, bespoke to every client that's looking for something different to leverage the traditional marketplace. So with that said, I have a few slides that I want to put up, right? We're presenting something a little bit different. What I want the audience to kind of take away is to use this as an extra tool in the toolbox, right? I always say that, and I hope everybody can see here. Robert, if you can just confirm that you can see this once I put this up.
There you go. Yep.
Perfect.
We see it.
Okay. So just giving you a little bit of a background of our group here. And we wanted to emphasize the green box on the right. We have various different solutions that fits for whatever challenges that you're kind of going through. And I'll go through some things that are applicable to the real estate industry. But you see some of the metrics on the left, right? We have 154 of these alternative risk programs, even though that says 140, and we surpassed $1 billion worth of gross written premium. What does that really tell you? That tells you that there's a significant demand in the real estate sector for alternative risk. It is due to that challenging kind of rate environment, but also at the same time, if you've taken a loss or two due to some of the natural catastrophes or just losses in general in terms of claims, well, it's going to be tough to get that traditional insurance capacity from your traditional marketplace. That's where the alternative risk comes in to offer something different. And we'll go through some of the programs that we're successful with putting together. These are some of the capabilities. I will go through the structured program and integrated program today because of the time constraints, but structured programs is a blend of risk financing and risk transfer. And we'll go through the mechanics of it and the details of it. But I think we were very successful at doing the structured programs for our real estate clients because of a couple of things, right? We are closely tied with our property colleagues within the organization of Marsh. That gives us that leverage and the expertise where we, as our alternative risk transfer group here at Marsh, we're not property experts. So we have to kind of marry this with our property expertise, and we let them kind of drive, and we act as an extension of that group. But we're able to create a multi-year solution for our clients to have that fixed rate, but at the same time, that budget certainty, right? Knowing what you're going to pay in a 3-year spectrum, and also that risk financing component. And the example will make a lot of sense when we go through the numbers, but the risk financing component, think about that like a virtual captive, right? And when we say a captive, it's your own proprietary kind of insurance company, but without having to set up a captive, we're allocating a big portion of that premium to sit in what we call a notional experience balance, right? That's what the client sees the benefit of at the end of the multi-year period, is you get a significant bulk of that premium that you've paid. You see that back depending on the loss activity, okay? And then integrated programs, that's going to be a multi-year, multi-line solution. Think about an insurance program, and I'm sure everybody knows property, casualty, but some of the other ancillary lines like D&O, fiduciary, crime, cyber. Think about one policy, all those multiple lines included in that one policy, and one premium reflected, right? Something very different, but forward-looking type of an approach that we can build from a multi-line perspective. And then some of the other things that you're going to see: performance warranty for green energy, fronting, which is more of a evidence of insurance, and some of the advisory and project management that we do in our group. So structured solutions. Let's get into the structured risk solution. Structured risk solution, again, this is a multi-year program that blends risk financing and risk transfer into a single program structure. And why is it kind of illustrated on the right over here in that schematic that you see, that blue box on the bottom portion of your property program? Well, as you probably already know, if you're buying insurance for your property program, you know that the majority of the premium is embedded in that down low capacity, right? When we say down low, sometimes we'll call that a primary layer, but we know that the primary layer has the most amount of volatility, and the losses that come in will hit that primary layer first. So that's why the insurance carriers are out there charging the most amount of premium. And we want that to be a kind of a trade-off with the structured risk solution, right? And the structured risk solution is positioned down low because when you're paying that significant rate online, well, at a certain point, you're really paying the traditional markets knowing that that's dead cash, right? The traditional markets are going to collect that premium on an annual basis, and you're really not going to see that premium back. That's what they're charging you to give you that insurance, right? Basically, if there's a loss, they're going to pay for the losses. But if there's no loss, well, they're keeping that premium as their profit, right? Their underwriting profit. On the casualty, we're kind of seeing the same kind of down low, but we're seeing it for the entirety of the layer. The difference between either or, the property, we see a lot more of what we call a quota share, or a share of that primary space, to have a traditional capacity going side by side with their alternative risk structured risk program. So something to consider. The highlight of these programs are that there's a fixed premium and there's a returnable premium function after the end of 3 years through what we call a commutation. A commutation is basically when we end the program, but a lot of our clients have really utilized this as that virtual captive idea. And when we have this program for 3 years, majority of our clients are actually pushing this for the renewal term, right? So when we say renewal, the renewals are every 3 years, meaning that when you renew for year 4, 5, and 6, you're basically pushing that premium that's left over, right? The returnable premium into the future years for the credits that you can receive. So something to keep in mind. And you know that the premium is going to be fixed over the next 3 years with some kind of an exposure adjustment. but that return premium is the big upside to this program.
Aiden, let me jump in.
Sure.
For the people joining us today, who's the market for this? I mean, are there certain people? I mean, obviously, maybe somebody's got a small office building or a little strip center or whatever would not be eligible, right? What's the kind of the minimum entry level to look at these types of programs?
Yeah, we usually say middle market clients and up, right? When we say middle market, it can be a revenue or TIV size, but the revenue usually floats around 100 million or more. That's usually where we see clients that make sense. But it's also not purely about revenue or TIV, right? Sometimes it's about the rate online. When we say rate online, it's how much premium is being charged for the capacity or the limit that you're buying. So I think that's a great time to kind of flip over to the next, right? When we say about the limits. This example is actually showing you what this program actually is, right? So from a 3-year program perspective, we're focusing on the 10 million layer. This is where, as an example, let's say this hypothetical example, this client is paying $5 million a year. So basically 50 million, a 50% rate online for a $10 million layer. Well, if you're paying that in the traditional market for that $10 million layer, after you pay that 5 million, that 5 million is the risk transfer cost, right? But in our program, what we can do is basically collect that 15 million over the next 3 years, so 5 times 3, and then we're having a returnable premium of 10, right? So basically, we've charged only 5 million instead of that 15 over the next 3 years, right? But for that 10 million, even though that's a returnable premium, we're using that as the loss funding to basically pay for losses. But if the losses are less than that 10 million, that's what our clients are seeing back as that profit sharing or return premium, right? So let's say that hypothetically you have 0 losses in the next 3 years. Well, your premium cost has been 5 million for that 3 years versus what the traditional market we're charging you 3 times that cost.
So Aiden, wouldn't this tend to result in people being very selective on submitting claims? If you essentially know that your potential return of premium of the 10 million in your example is going to be reduced by whatever dollar for dollar loss, why put in $100,000 claim if you know that essentially you're going to not get that 100,000 back? It's kind of 6 of one, half dozen the other. But I think, again, the more claims you get, the higher risk will be perceived for the future periods, right? So you might be better even on a dollar for dollar just to absorb that internally.
Yeah, so Robert, the great point, right? I think John brought up the deductible idea in the beginning, right? The aggregate deductible. It's a similar concept, right? If you decide that you wanna keep that the 10 million loss funding intact, and you don't want to have the nicks and cuts go into this program, that's a decision that a company can make, right? Whether you want to erode the loss funding or not, or have a bigger ag deductible sitting beneath this program to take care of some of the smaller claims.
And you also talked about TIV. Is that what total insurable value, just to get the jargon there?
That's correct, Robert.
Okay, sounds good. Good.
Yeah.
Go right on.
Yeah, so this is a program, and there's limitations to this program as well, right? Because there's a certain return premium and a fixed cost to this program. Here's the limits that we're kind of thinking about for this program. We're focusing on the 10 million layer, but there's an aggregate of 10 million on a per occurrence. So just like a traditional program, it's going to act like it's going to be in that 10 million position. But from any 1 year, so from an annual aggregate perspective, there's a 20 million. So basically you can have 2 full losses in any 1 year out of that 3-year spectrum. But out of that 3-year term aggregate, there's a 30 million cap. So basically, there's a certain ceiling to this program, and you're probably wondering, well, what if we hit those numbers, right? What's the likelihood or the probability of exhausting that 10 million on a per occurrence, 20 million on an aggregate annual aggregate, or 30 over a 3-year term. These programs are highly actuarially modeled, meaning that we want to make sure the probability of exhausting that 20 million annual aggregate or the 30 million annual aggregate, we're going to do that legwork for you before we jump in head first, and make sure that you have enough limits to shield you against the probabilities from, what is it? Is it a 1 in 20-year event? Is it a 1 in 50-year event? 1 in 100-year event? We like to have that comfort before we design these kind of programs. Something to keep in mind.
Okay. Let's move on, and then I want to get John back in here. So Aiden, go ahead.
So there are a lot of different ways to design this program, right? But I think the easiest one has been the pre-funded program, knowing that there's a certain premium tied and associated with the traditional program. We don't want to deviate, or we don't want our programs to be more expensive or less expensive, right? We want to keep it apples to apples. That's where the qualifying of whether this fits into a structured program or not makes sense. And there are a lot of different ways to do it, but the pre-funded program is exactly what we just showed on the screen before this page, was basically allocating, let's say, 70 to 75% of your upfront premium into that loss funding, or that notional experience balance, as a returnable function, but also acting as that loss fund, right? Quarter retention. If you're not comfortable with paying that high amount of premium, but maybe you want to minimize the upfront cost, that's something that you can do on a corridor retention, meaning that as the loss occurs, you can pay for the losses with a retention mechanism versus an upfront cost mechanism. And then the swing is something very similar to the corridor, except there's a swing up in the premium depending on your loss activity. And then a cancel rewrite is a little more complex, where you have the ability to keep the costs lower, but at the same time, you have the ability to cancel the program and to rewrite it with an annualized kind of a program structure. So this is the main focus of a structured program, and we will share the slide that we have here. But again, this is a multi-year, multi-line program. I just wanted to show an example what this can look like. This is not for everybody, right? The multi-line, multi-year program is not for everybody, but it's for customers that are looking for more of an all-encompassing type of an insurance program structure, that you could include multiple lines without having that different renewal period or effective dates, and you can lock this away for 3 years without worrying about the fluctuation in the rate environment. So right back to
and we have carriers that are willing to cover all these different lines, because I think all of us know, even on down to a personal level, if you've got homeowners insurance, you got the same auto insurance provider, you can get some kind of discounts. Is that the same concept at the higher level?
Very similar, Robert. I think the mass of what you're putting into this program, there's a lot of different mechanics of structuring. So when we say structuring, it's about designing of the program, and we could take advantage of playing around with the aggregate deductible, or having this sit in a certain position on your insurance program. But it's really about the customization and how much we put into this program. And like you said, right, the selectiveness of what lines we put in, and the market that decides to do this program, we can get that combination of the upfront savings from having it with one carrier, but also playing around with the aggregate retention or deductible within the program.
Are there certain things like flood insurance and a hurricane, earthquake, that maybe you need to go to a separate provider?
That's right, Robert. And we can mix and match. Sometimes when we see the structure program, and this is probably a good example to kind of talk about that, Robert. I think the structure program, you can definitely mirror the terms and conditions and some of the bells and whistles that you see in the traditional market. And John and I have worked on accounts in the past where, you know, I certainly lead in with his expertise, and we don't try to deviate from the terms and conditions from the traditional marketplace, right? We want this to have the same features from what you just mentioned, whether it's flood, wind, or some of the other perils to be included in this program. And this is insurance from day one, right? I want the audience to kind of understand that you still get a paper from any one of the major carriers that we work with, and the terms and conditions, as well as the policy language from a legal perspective.
Okay, so you're going to get backing by solid carriers that will be there if and when the losses occur. Let's bring John back in and let him comment on anything that he would like to comment on, or feel free to even ask a question of Aidan or challenge Aidan. John?
No, Robert, I think you mentioned a great point at the end around the carriers that are behind this. And I think I'm sure one of the questions is, are lenders getting behind this, and how are they responding to these creative solutions? Because this is all well and good, but for most of the participants on this call, there's a third party that has a lot of say over the insurance structures that you implement. And I think the good news is that Aidan and his team are very good about working with some of the best carriers in the business. So all of the carriers are going to be, highly rated and won't create issues from a lending perspective. But in addition to this, I think the lenders are now understanding a lot of these unique structures. And as long as the structure is appropriate, the financing is in place, we haven't seen lenders push back on aggregate deductibles, these types of structures, because they understand that the market is going up, and if we can't behave the exact same way and expect premiums to rise 10-15% every year, and unless we try to revise these structures, if losses keep going up and carriers still need to continue to be profitable enterprises, they're going to need to increase their premiums. And for every dollar of losses, they need to increase their premiums $1.50. So I think to Aidan's presentation, it's how can we take some of those dollars that we've historically transferred to the markets, cap them so we don't have additional out-of-pocket risk, but take that $1.50 that we were giving to the markets and reposition that so we're only paying dollar for dollar on those losses.
Right. I think the same point with this inflation hitting everything is the same way you're seeing losses and medical care losses or personal injuries going up. You're seeing building costs going up, but I'm sure the administrative side to administer these claims, the cost of the human element at insurance companies, right? Somebody processing claims, adjusters going out in the field, all of that flows through. So I wanted to kind of follow up. So one of the takeaways I have is you certainly want to think twice before certain types of claims are made. So maybe you got, again, a very small fire isolated to a storage space, or a kitchen fire in an apartment or something like that. But also I would think water losses would be ones. Are there any other categories that jump out that you think maybe disproportionately are overreacted to by the insurance industry, other than water loss and fire? I mean, what kind of claims should you really think twice about submitting?
Yeah, and I think it's a great comment, because what carriers hate is paying, if you've got a $25,000 deductible, regardless of what the claim is, if you're submitting a claim for $27,500, and the carrier is probably going to spend $5,000 to $10,000 adjusting that claim to pay you $2,500. And even if at the end of the year, you're still a profitable risk to the insurance carrier, right? That was your only claim. They hate paying that $2,500 payment so much that what they'll do is, when you have those types of frequency events, they'll just push to increase your deductibles. If you have, 3 or 4 $125,000 water damage claims, your deductible's probably going to get pushed to $250K next year. So it's looking at those types of events. And I think it's not so much the type of loss, but the size of the loss. It's figuring out if this loss is just going to pierce the deductible. It's more efficient for you as an owner to probably pay that out of pocket, out of the property, versus try and go to your insurance carrier for every one of these claims. So what I would recommend, and we do this for a lot of our clients, is figure out the threshold. If your deductible is $25,000, don't submit any claims under $30,000. Don't submit them under $35,000. So it's coming up with some internal processes So you're not using your insurance carriers like a pure piggy bank, and there's some strategy around claims. But I would say water damage is probably the biggest one that you want to control what you're pushing to the marketplace. It's where carriers have seen the most frequency of losses, and where they're most aggressively pushing higher deductibles. They may say, okay, you can keep your $25,000 or $100,000 deductible for fire, but water damage is going to $250,000. Water damage is going to $500,000. And so it's better to try and self-insure some of those losses where you can, so that when you have the $250,000 loss, you can collect $150,000, and you maximize that insurance when you need it. And to your point around the increased cost of administering claims, depending on your policy structure, many of you may have one carrier that insures your properties. Others, if you're buying insurance on a programmatic basis, on the property insurance side, you could have 5 or 10 different carriers that are participating in your primary limit of insurance. And when you think about that, I think some carriers say that it costs them $5,000 to open up a claim file. Well, if you've got 5 carriers on your primary, there's $25,000 in adjustment losses that we pay right off the bat. So the administrative cost of everything around this business is rising. And ultimately, with insurances, it gets passed back to you as the buyers of coverage. So we want to be diligent about when and how to push risk to the markets versus retain it ourselves.
So there's no free lunch. That's a big takeaway, right? Like you said, the insurance companies are in the business to be a profitable business. One thing I wanted to, so this idea of variable deductibles for different types of losses, I think that's interesting, and that might be open up some things, because you said earlier, John, you don't want to be over-insured, and maybe people are just used to getting this boilerplate. We've done this. Your insurance agent might even be second generation. They're just passing on what a prior generation did. Some properties have the same insurance carrier for years and same agent. But I did want to follow up with one thing you'd said earlier, that if you get data. This wind event you said was really a 1,000 year. Who do you call to get that type of it? Who is the person that would be giving you data that the insurance agents as well, and insurance industry as well as the lenders would believe is credible in order to basically push back on some of these? So who comes out and says, hey, that wind event was a 1 in 1,000? Is that a meteorologist, or who do you call?
Certainly. And that's where I think it's very important to make sure that you have a good broker who's operating on your behalf, because all of that data quality, you're reliant on your broker to push this information to the markets and to negotiate on your behalf. And most insurance brokers will either have access to, or via a wholesale carrier or wholesale broker, have access to modeling software. There are 2 major modeling software providers. There's AIR and RMS. RMS is typically the one that the default modeling program for lenders. But what you'll do is you take that information, you'll take your exposure information, you'll give it to a broker. If you work with Marsh has internal modeling. You'll send it to your Marsh team. They'll come back to you and say, here's your modeling results. And it's usually a 15, 20-page document that will go through various, I would say, catastrophic risks. Named storm and earthquake are typically the most frequent that we see used here. And it'll show, here's your loss expectancy in a 250-year storm, 500-year storm, 1,000-year storm, and all the way up. So you can take that information, and we did this a few months ago. The loan agreement had been signed 5 years ago. Lender was requiring full limits for named storm. We wanted to purchase $50 million of coverage. We ran a model that showed that our loss expectancy at the 10,000-year return period, which I think dates us back to the end of the New Stone Age, was $42 million. So at that point, we went to the lender and said, we've got a 5-year loan, and you're asking us to buy full limits for named storm. We're showing you the more conservative model that's showing that in a 10,000 year storm event, we're looking at expected loss of $42 million. You know,
Okay, well, we're unfortunately out of time. I appreciate that, and I certainly have a to-do list here. Obviously, seeking waivers of values deductibles from your lender, breaking down your deductibles for different types of losses, and making sure CoreLogic knows that you replace that roof or you don't have Zinsco panels. John, would you come back in and wrap us up? Thank you, John. Thank you, Aiden. Great presentation. So
thank you very much for the time.
Thank you so much.
Thank you, Robert, John, and Aiden. It was terrific. I think I'd add to Robert's takeaways my two simple ones. One, have quality data. If you're going to start a discussion with anyone, make sure that your data is good and vet it. And second, a lot of these risk transfer discussions really come down to keeping the risk yourself and figure out how to do that. And we went through some tools and ways in which you might manage that. So thanks very much to all of you. And finally, please join us on May 8th for Urban Challenges. Is the death of the downtown premature or inevitable? Look for details soon. Until then, on behalf of the Councils of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience.